Well, here we go. What an honour, what a treat to have Mikey joining us on a Monday. Mikey on a Monday.
Monday,
how are you, mate?
Live. Very good.
It's good.
Very good.
Yeah.
Still cranking, still on the grind. Level 3 makes no difference to me.
Well, we won't hold you too long because I know that your favourite minister is speaking at 3 o'clock today, so you'll need to hear everything that he's got to say, right?
That's right. I'm looking forward to it, and I don't want to hold people up because everyone will be tuned into this rather than that. So we've got to make sure we don't stop them from being able to see it themselves.
100%. All right, for anyone just tuning in, Mikey is a mortgage advisor at Loan Market. He's someone that I trust. I ask him all of my questions around mortgages, borrowing, debt, things to think about. I refer on a lot of the questions that I get to Mikey because I don't necessarily have the same knowledge that he has. He studies the stuff 80 hours a week, which is longer than I, but he's easy to talk to and can break things down into plain language. So I've collected a few questions for you, mate. We're going to hit you with them. And if anybody has any questions, they can drop them in the comments as well. Or if you don't want to make yourself known and want to stay anonymous, you can always email Mikey at mikey.smith@loanmarket.co.nz. But without getting too stuck in the weeds, mate, I will just start by asking you I know you've got quite an interesting background that I think people would be interested in, and you practice what you preach, and the fact that you've actually got rental properties and stuff yourself.
Yeah, and the day after the second round of level 3 lockdown, I just signed up to another one. So I don't take part in recessions if they pop up.
Good man. You're going to get busy with
it. Yeah, I'm a believer in the passive income sort of thing, creating. I'm not a believer in capital gain, as a lot of people are in property. Obviously, it's there and it's happened for the last however many years, and there's all those things about Auckland house prices double every 10 years, but we've also had 35 years of falling interest rates pretty consistently. So I think when we get down to these levels, you're better to base your calculations on your return on your investment from the cash flow that rolls in. So I've been running that type of model in my own personal stuff for the last 5 years. Pretty much for those last 5 years, my properties have cost me zero, apart from the initial deposit that I put down. And I mean, that's made itself back plenty with its capital gain, but it still doesn't worry me at all.
Yeah. So just explain that for people that might be wondering how the hell you've got a number of houses and you haven't spent anything more than your original deposit. Is that leverage?
Yeah, correct. So unknowingly, I bought my first house in Auckland. It was a 2-bedroom brick and tile unit. It was a heap of junk. And I went to get some, I went to the bank actually and said, I want to top up to do some renovations. And they gave me a valuation and it came in at 150 grand more than what I'd paid for it at the time. And then I went into a deep, dark hole of about 18 months, teaching myself about what equity is and how to use it. And then with that extra value in the property, I went and bought my first rental property.
Wow.
That had gone up in value. I'd paid off some mortgage. There's a whole lot of equity sitting there. Went and bought a rental property with none of my money. And then did it again. And now I'm doing it again. I sold that original house. That was my own house. And I'm a little bit of a believer in not owning my own house. I'm sort of a rent guy. One day I probably
It would be fascinating for people listening. I think the fact that you've got a number of homes, more than just 1, 2, or 3, and you're saying that you're still happy to rent. That's like throws out everything that we kind of get taught to do in New Zealand.
Yeah, it's not really the Kiwi dream, is it? Quarter acre and 2 bathrooms and a place for the barbecue. Yeah, interesting.
Yeah. Okay. Well, if anyone wants to understand what Mikey's talking about a little bit further, I wrote about leverage on Friday, and I didn't get any emails back saying you've got this wrong. So I assume it was correct, and I did get you to cast your eye over it as well. But it is something that people can use to their advantage. And I was writing something for Keep the Change Night School earlier today around looking at retirement in a different angle. And one of those things is that, like, a lot of people think I need to have a merely to be able to retire, and then they freak out because they think that's so unachievable. But one of the real practical goals, exactly what you're doing, is actually to reshape and go, can I have a freehold property that then I don't have to pay to live in by the time I retire? And even better, could I have a property that pays me an income stream? And then you add that to your pension, you add that to working maybe 2 days a week, and you add that to having, well, I think you only need 2 of the 3, and basically you can achieve a New Zealand average income today, basically in your retirement. So that makes it look, or is a lot more achievable than people realize if you look at it more practically like that when you start drawing from your KiwiSaver. But that using property to generate an income stream is obviously very popular. But I guess, are you saying you see a lot of people fall into the trap of just hoping they're doing it for the capital gain reason, not the passive income stream?
Yeah, 100%. So, like, capital gain to me is not really investment. I mean, there are guys that will study where infrastructure is going to be put in and things like that, but basically mum and dads in Auckland, for example, that have been doing it, it's speculation. Investment is like calculating your risk, your return on your investment and stuff like that. And who knows what capital gain you're going to get. That's speculation. Knowing what the rent is going to be on a property, how much you've spent on it, working out those numbers, that's investment, and getting those numbers right. It's not guessing. It's a much more accurate way of doing things. And it's not actually that hard once you've learned to work out that stuff to create like a passive income or basically another salary for yourself over time.
Yeah.
Like for people our age now, like it would be very easy to jump in now and create $60,000 to $100,000 worth of income by the time you're 65. And who would want that? Yeah,
exactly. It's more than the average age at the moment for you, and you're not actually working for it as such. So, well, speaking of getting the numbers right, mate, what are the common mistakes that you see people making before they come and speak to you? Like, what's the same conversation you have all the time that you just think, I wish I didn't have to have this conversation. I wish I told them this 6 months ago.
Yeah. It's interesting now with how the banks are going, which is actually a good thing, that the things that pop up regularly are account conduct. And we have discussions around that, and you really need to get that in check. Like that's, it's all very well earning $150,000 a year, say, and you can look at the mortgage calculator and say, oh, that $700,000 mortgage only costs $600 a week at the moment with these rates. But if you're spending all of your income and not showing that there's $600 lying around after your expenses, the bank are going to start asking questions, and we're leaning more and more towards the banks not taking you on. They want to see you showing that you can save, and plus whatever your costs in rent are would be similar to owning a property. So, I mean, one of the most common mistakes is when I sit down with someone and we talk about account conduct, and they're like, right, so my rent and my rent and my savings are sort of close to what the mortgage repayment would be, but I'm not saving enough for a deposit because my rent's $600 and my savings is $250 a week. So we talk about it. They get fully understood, and then they go move home with mum and dad to save more money. They move home with mum and dad. Yeah, and then life's pretty good because cash flows just increase a hell of a lot. There's a bit more eating out, and the savings doesn't actually add up to the rent plus the savings that you had before when you were renting. You're saving more money, but when we go to the bank and say, hey, this mortgage costs $500 or $600 a week, but you've only been saving $450, they'll pull you up on it and say, no, come back in 6 months and get this sorted.
Really? So they're teaching you to save your entire mortgage repayment, basically. So you've got to try and show that you can actually do that, so they've got the confidence to meet your payments. Yep.
And I mean, if you've got something like a car finance loan that, say, costs, I don't know, $150 a week, that can be part of that affordability calculation. So, but ideally you want it paid off when you come into the loan time, the mortgage time. So you have a whole lot of things that add up to sort of monthly expenses. we can use that to show affordability. It's got to basically add up to that mortgage repayment plus your insurance and a bit of like ownership maintenance. So generally speaking, $4 or $5 grand a year, which is another $100 a week.
Yeah. Wow. So would you say for people that are, say, 6 months out from coming to talk or think about buying a property or from just borrowing in general, should they be thinking about trying to delete that debt, as I call it? Like get rid of those small debts like credit cards, your gem visas, your Q cards, your car finances, anything like that? Like try and get rid of as many of those as you can before you get to that stage?
100%. Those things are taxing on your cash flow, eh?
Yeah.
Well, you've got those things. You should not be saving that money until you've got rid of that stuff. That is number one. Like, none of the interest rates on that stuff, is fair, or you just shouldn't have it. You need to get rid of it. Do anything you can at all costs to get rid of any credit cards 20% interest rates. Horrendous. It's just they're out of control, and people get into a bit of a trap because a minimum repayment on a small amount like $1,000 is actually, it feels like bugger all, but that stuff is just taxing your savings, and it actually reduces your borrowing capacity when it comes time to get a property.
So you want to be mindful of racking up credit card debt and then only making minimum repayments. What if you're using a credit card smartly, like you're putting your transactions on there, then you're paying it off? It's the Kiwi thing to do. I'm getting my ear points, I'm getting my bloody flybys or whatever. We get sucked into that.
Mate, I bought these fresh boots with credit card points.
They are Ren Williams boots. I bet they are. They've done well with their marketing. Oh, they love it
very well. It's a hell of a company. It's an interesting one. I'd like to study that one, actually.
Also,
the sensible way to use a credit card. Yep, it can be done for the most financially disciplined people only. Still have to take into consideration when it does come time for a home loan and applying for it. Each bank's a little bit different, but whatever the credit card limit is, the bank will calculate a percentage. Sometimes it's 3%, around the 3% mark, as expenditure wiped off your net income. So if you're like me and roll around with a stupidly high limit, they will calculate a percentage of that and basically take that off your net income. Therefore, they think that you can service less because you've got a lower income, and reduce that borrowing.
I see. So that they're factoring that in by decreasing your income, knowing that you may rack it up and you can pay it off. And what other things make up account conduct, mate? Is that like if you keep going to Subway all the time, maybe you visit some establishments that are not, necessarily great in the eye of the bank, perhaps pubs or
I think you saw my post the other day about the lotto ticket, right?
I was going to ask you about these.
Hell of an example. I won bugger all. I'm not one of the 10 people that won $5 million. But that kind of stuff, lotto or consistent booze shops, even stuff like that. That if you have a lotto and my lotto pop up sort of every week or once a month or anything like that, those things are massively taken into consideration now. They are poor financial habits, and I mean, it probably shows a little bit of a lack of financial discipline. Therefore, once again, it's just reducing that net income that they use to calculate how much you borrow. So if you're spending $100 a month on lotto tickets, it's 12 grand a year that you just reduce your net income by.
1,200
or 1,000.
100. Hopefully $1,000 of a ticket.
Expensive.
I know. Well, so do the banks have software where they're like pulling your transactional data and like going quickly? Because surely they're not going through every bank line for 6 months going, there he is again, down to that bloody, got another scratchy. So I'm not sure what each bank has behind the scenes to check stuff, but I've got a product now which basically just separates all of your expenses and puts them into categories. And there's certain ones that pop up, like the TAB we've talked about. They'll go into the red category.
And yeah, lotto will come under gambling and things like that, and they get marked, and I get made aware of them in the software, and then I look at them and work out how bad it is, or if it's not much, and take into consideration. And basically, it can be okay to have some of these things, but you just have to be able to cover it and some with your income. So it does restrict your borrowing, and I mean, I don't know if the banks are sitting there going through every little expense, but they must have a software like what I've got to be able to check this stuff.
Look, if you've got it, surely they've got it. Well, what about if Lukey, he's over here, he's got a little account off to the side and he's siphoning a bit off, just doing all my questionable activity over there. Are they going to spot that? Are you going to spot that?
100%. You could probably not disclose it to me. And as soon as we submit your application, if you didn't disclose it to me, they're going to do a credit check, and anything that has your name linked to it will pop up. The bank will then send me an email and say, hey, all of Luke's banking's at Westpac, but there's a BNZ account. How come we haven't got statements for that? Then I look like a dick. Yeah. And you're going to be embarrassed when I call you. And they'll find it. They've been doing this much longer than all of us have put together, so they've seen it all before.
Well, here's one live in the comments here saying it's a giant comment from Maddie Wingham. Got decline of 100K in the bin, KiwiSaver savings, zero debt, making 100 grand the last 3 years. Account contact the main reason being declined. Play poker part-time professionally and have a ton of cash in and out with some tab. Been told to tidy it up and come back in 6 months. So there you go. It's exactly what you're talking about, right?
There's the proof of it, right? So, that's exactly what's happening. And the days are sort of gone of where you can just call up mum and dad and ask for a guarantor, like you need to be able to service that debt, and they will wipe those things and they'll add those things to your expenses column and just wipe them off your net income.
Yeah. Okay. Well, we'll leave account conduct there. It sounds like that's critical for people to be thinking about and probably getting in touch if they want to know more about that, or even just having a Google or something, trying to understand more of what it means. I think we probably both are quite economically minded, and maybe I'd probably go as far as saying that we're both geeks in that space. So we probably both believe that interest rates are going to go down further. Do you agree? Yeah.
Yeah, I think so. I think I've sort of, since the beginning of this year, I've underestimated the power of the Reserve Bank and stimulus and stuff like that. It forced me to learn even more at a really quick rate, and I've looked into it more. I think they've got more room to move. Yeah. I'm not sure if we can go into the 1% range in terms of fixed home loan rates. I think low twos will be pretty close to the bottom, but I think we're going to see more.
Okay. Well, I had a mate on the weekend say to me that I'm currently paying 3.39, I think, percent interest, and they've been offered 2.5, but they're on a fixed rate finishing early next year. What do people need to think about when they start going down this path of, right, I might break my mortgage and chase a lower rate? Because as Kiwis, we love chasing a lower rate, right?
Yeah, it's a bit like tax. Just pay it and get it sorted. Put your effort into making more money. But the break fee is an interesting one. Generally speaking, breaking and taking on a new rate at the moment is not worth it.
Okay.
More or less, it costs you a little bit more to break than the saving you'll get on the interest rate. The reason for that is that when you took out the 3.39% interest rate, the bank actually borrowed the money for that 3.39% at a higher rate than what they're borrowing the 2.5% money at. So you've got to pay the difference, which is going to be a loss now for going on to the new rate. I don't want to get too super geeky into the details of how it works. There's a few calculators around to work it out. But yeah, I mean, the way to combat it is to actually do a bank switch sometimes, and the other bank will pay you a cashback, which can counter some of that cost. Even still, they're a little bit hard to get right, and generally speaking, it's better to wait it out.
Yeah. What? Just while I've got you on that, so could people just ring the bank and say, "Hey, I want a better rate," sort it out? Does that work?
You can try, but generally you'll get laughed at.
Okay.
I
Right. I don't even have a mortgage.
I mean, 1 in 10 existing mortgages can probably be sharpened up with a bank move, and it's always worth going to your own bank first and sort of offering them to keep you. I mean, that's part of what my job is the negotiation side of it, right? And presenting banks with the option to either keep or let them go. And I always go and present to the main bank first. And they might sharpen something up or shave a little cost off or a little sharper rate or something to keep someone there. Then you don't have to go through the hassle of moving banks, because that is a hassle.
Yeah, and I guess from a banking standpoint, like it's cheaper to look after the customers you have, right, than try and get a new one. So I guess that's why retention is a massive focus point for a lot of them now.
Yeah. I mean, if I was a bank, I would be full on retention. I'd try and keep every single person that walked through the door. I think it's a far more cost-effective way to sign someone up to a mortgage and try and keep them there for the 20 or 30 years that they're going to have the loan than chopping and changing new clients every 3 years because people are churning through banks, you know. You do get a better service when you stay with your bank. It's not like the 70s these days because the volume is so high. But yeah, you do get better looked after if you stay with your own bank.
Okay. And so why should people consider using a mortgage advisor rather than just going directly to the bank? Like, what are people getting that that they don't understand that they're missing out on if they don't seek some advice and help?
Oh, I could write a 30-page article on this, eh? We might miss the conference. So my personal opinion, after being in the industry for a while now, is that you're a plumber, say. You're the guy that knows about plumbing. I would hire you to do my plumbing because you live and breathe it every day.
Yeah.
I'm the guy that deals with the banks day in, day out. I study them. I read their policy. I'm working on client after client. So use the guy that can provide the advice to do it right. One of the biggest ones that I see, which is probably a good thing for me, free's a good one. Why not? Free of charge. There you go. But the terminology, like I have to remind myself when I'm talking to clients to try and use what I call layman's terms, you know, like you can get out of hand with all the abbreviations and what things mean. And it's speaking normally and treating people normally so they understand it and educating them in a way so they feel like they've got a full control over what's going on. But you just won't get that talking over the counter at the bank, you know.
Do you find that because you've got properties as well and you're kind of living the journey that your clients are going on, it's easier for them to relate to you and you to relate to them and break it down?
100%. It's a much easier thing to explain someone the process from securing getting your account conduct in check, securing pre-approval, buying a place, doing your loan structure, settling, moving in, connecting up telephones, talking to a lawyer, making sure your accountants are like all this kind of stuff when you've done it yourself. Like that's just an experience thing, right? So you can be a mortgage broker just by knowing bank policy, but having the full package is a massive advantage to me. Yeah.
Hey, this one might be more of like an approved financial advisor type question, but you know, if you're going to use your KiwiSaver for the first time and you're looking to use that money to buy a home, I had a young fella say to me, I'm pouring more and more money into my KiwiSaver so that I can use it for my first home. Is there any benefit of doing that when they could just withhold that money themselves and choose where to invest it themselves, or just squirrel it and build up a fund as well? Like, is there any real difference, or are they just attacking it from probably a different piece of education?
Yeah, well, there's different ways to look at that, right? Smashing it into your KiwiSaver to buy your first home just means that you have to buy it and live in it.
Yeah,
that's one thing. If you put your KiwiSaver down to a minimum and thought about leaving it until you're 65 years old, and that extra money that you're putting aside, then you could buy a rental property on a single deposit. up to size, you know. I don't know, that it is probably more of a super duper financial advisor question, because there's so many variables with a question like that. If he's going to smash out for his home to live in, it's not a bad idea. Then you just get some advice around what fund you want to be in, if it's going to be conservative or growth. Or a lot of guys are sitting around on growth that we're about to buy a house in March and watch 20% get wiped off when they should have probably been in a conservative fund a year out, knowing that they're going to buy a house. If that was your main focus of your fund, then you've got to take all of that stuff into consideration.
Yeah, matching. Well, this will be a great educator, I think, of people's financial literacy, because people have been forced to learn some of these things, and unfortunately the hard way for a lot of people. But matching your risk portfolio to the stage of your life is obviously fundamental, but something that's not really been taught that well, as people just go into default funds and stuff, right? So yeah, I think that will be a wake-up call for people.
It's a great wake-up call for people, and a lot of people got real shaky when they watch their KiwiSaver drop, you know. And if you get shaky when you watch that drop, you're probably in the wrong fund, because you should be able to sleep at night and not worried about 3% of your income sitting over there, you know. It's not the right place to be in. So maybe you should look at a long-term conservative fund if that was you. Otherwise, just get ready to ride the wave out the other side, because it'll feel good.
Bit of surfing the economy. When I do all of this research for around finances, money, my own planning, failure, everything comes back a lot to the fact that people don't actually have a long-term financial plan. And that doesn't have to be this, like, it sounds like it's really fancy, but it's literally like, oh, by this age, I want to have a freehold property, or I want to have a KiwiSaver of this amount. Here's how I'm going to do it. Like, we don't really get taught to do that. With the clients that you're working with, do you see like any of them at all sort of actually saying, hey, can you help us do this because we're working to this plan? Or are they just going like, oh, we would love to buy a home built off of emotion?
Yeah. So times are changing as well in the banking sector for this stuff. So first meeting, sit down. It's definitely almost a goals planning session. You know, I want to get into the nuts and bolts, find out what the plan is. And if someone comes and says, I just want to buy a home, I've got a deposit, then we have to sort of take that and nurture it a bit and work out and dig into where they actually want to go. Taking on a 700K loan is not actually for the faint-hearted, and we've got very used to if you can afford it by the week. There's a good chance that if you take on a 30-year loan, that the repayments aren't always going to be the same over the next 30 years. You know, interest rates can go up. It's a possibility. So it's a massive part of it. I really get quite detailed into the next 5 years. Need to find out about work, career, family, children. All of that stuff's really important to build into it, because if a couple's 2 years away from having a kid, that's one income down, and you're asking for a loan based off two incomes. So you need to think about that stuff, be ready for it, be aware of it, because it'll be a shock if you do it without preparing for it.
Yeah. Do we still have like an emotional attachment to housing in New Zealand from what you see, where people sort of feel like they have to have a house by a certain age and those sorts of things, and they're coming to you to try and basically just say, hey, like, this is my right, make it happen somehow? Yeah,
for sure. Yeah, there's like I hate this word, but the entitlement. Actually, personally, I've been a massive fan of the LVR rules when they came in, when the Reserve Bank implemented LVR rules, going away from sort of 90 to 100% lending and all that kind of stuff. It was finally like, oh, you actually have to save money to buy a house. And that has been great, because people still think that they want to buy a house, but it's a commonly known thing now that you have to save up a deposit. And some people will just kick it down the road and be like, sweet, I'm going to rent for life. What a shame. But other people that still want it, it actually creates a bit of financial discipline, sort of unknowingly almost. There is entitlement round, but I mean, you simply won't get a loan if you're not going to look after your finances anymore. So, see you in 6 months.
Yeah. So you could have all the deposit and capital you need and all support from family, but if you can't show good account conduct, you could be stuffed.
Yeah, I mean, you can still do guarantors and things like that, but they really want to see you showing that you can, basically. It's a massive one.
I read yesterday that the average mortgage in Australia is 9 times the household income. So do you know roughly what that is in New Zealand? Would that be similar?
Similar, yeah. It could be 10. You can relax a bit. It's the household income.
Yeah.
So generally speaking, we're taking this on as a couple. So you can think of it as sort of 4 to 5 times your own personal income.
Yeah. There's a question here, and I know that you're not an economist, mate, but you might as well be. Between both of us would probably spend way too much time in the study of economics. But what would cause interest rates to go up in the next 5 years? Any quick answers there?
Inflation.
Yeah.
So
yeah.
Do you want to take that one on?
So basically, if we're in a low interest environment, people might spend. It's encouraging us to spend money, right, to free up money that we'd be spending and paying to the bank, and that's driving spending in the economy. And then if that leads to inflation with things getting more expensive, which has happened in historic economic times where we've already seen food go up 9% since the first lockdown, things like that, and we sort of don't actually realize they're happening, but prices are creeping up around us and the cost of living is getting more and more expensive. What they'll try and do is manipulate the interest rate to basically slow down people's spending and get them to readjust their lifestyles. This has been a traditional tool used by the Reserve Bank to control inflation in the economy. Does it work anymore? We're probably not the guys to be asking. I don't think the economists in New Zealand at the moment are the guys to be asking either. We're in a completely new age and way where we're just printing money via changing some digits on a screen. So that money has to go somewhere in the economy, and where it flushes out, who knows? But what Mikey's saying is that basically if inflation does get rampant, then we'll have to, or one way to help sort that is by increasing the interest rate, which then would affect borrowers.
It's a little bit scary to think about. You nailed it, mate. Got him. Yeah, it's a little bit scary to think about, and it's hard to believe that it could happen. But I mean, without going into the disconnect between like financial assets and stuff on the ground like fruit and veggies, if it got out of control, absolutely they'll turn it up, and it will hurt people who haven't sort of prepared for it. They will turn it up, slow it down real quick. If you see inflation at 10%, it's gonna be an interesting year. Yeah. So it is a good tool that they've got to do it.
Yeah.
There's lots of argument out there that it could be out of date, but it's what we've got to deal with, and that's why it's there.
So for people to combat that, they should probably be thinking about what I call like a shit hits the fan account. So they're just funneling off a percentage of their income as soon as they get paid to basically like an emergency fund, and building like a buffer for emergencies in the future today, so that when the emergency comes, you're like, okay, this isn't as stressful because you've actually been planning for it for a number of months or years.
100%. I run my personal finances and my business like that. You know, my tax phobia.
Yeah.
Call Luke on a Wednesday and say, mate, have I got enough money for tax? But
you're right on top of it, mate. You've got good structure. Very important.
It's a really important part. I don't even like doing a home loan for someone where we're using down to the last $500 to get it across the line,
Yeah.
It's scary. I would really prefer to see people with, if you're going to buy a home, you want 10K left over for moving day, at least. And it's sort of been like trained into us, the banks give you a cash back, so you get a lump of cash your first week when you're there, and it's almost like it's like trained out of us and we don't need it. But
Yeah,
man, rainy days come and they come real fast, a lot faster than the good days seem to turn up. So definitely have the backup.
do you remind people when they're looking at borrowing for a home, you sort of saying, so, hey, don't forget the furniture, don't forget those types of things, costs and things? Do people think about that stuff?
100%. That's part of that that sort of first meeting where we go over the goals and the next 5 years and stuff like that. What have you got? It's part of our assets and liabilities column and things like that. Like, do you have furniture?
Yeah.
Or are you going to go on a new 100-inch screen? You know, like, are you going to have to spend that money? So it's all stuff that's taken into account. It's interesting, like a mortgage advisor's job is a lot more than probably what we get thought about as is just getting an approval. It's making sure that this person's going to be okay in this home with this debt.
Yeah. Going for a loan is really like a really good educational exercise almost, especially when they're coupled with like the right person that can kind of help them see a whole heap of things they didn't realize were there, right?
100%. It's interesting, eh? Like if you can get a loan and if you couldn't get a loan a year ago and you can get a loan now, you've probably really sharpened up your financial discipline.
Yeah.
You've probably got better financial literacy. You understand your probably your net worth a lot more.
Yeah.
It's a pretty cool experience, actually. Like, it's a positive one. Everyone seems to badmouth the banks for it, but they're actually sort of getting you in line to be doing the right thing. It's just the taking on of $1 million loan that's a problem.
It's a scary bit. What about offset mortgages? Have been one of my favorite things to try and discuss with my parents as I was growing up, as a great tool to reduce the amount of interest they're paying by using some their savings that they had left over. But you're always paying a higher rate with an offset rate, aren't you? Are people still using them?
Yeah, they do get used. They seem to be not commonly used. They don't actually fit too many people. Okay. When you sit down and go through the numbers, a lot of the time it's better to pay off that debt, or I mean, if you've got some when they're good is normally short term, right? Like if you're parking this lump of cash because you're going to go on a trip in 3 years around the world for a year and you've got 100 grand sitting there, that's when it's really handy because you know it's not getting spent for that time. And as soon as you spend that 100 grand, though, your interest rate will go back up to 1.5% over what the fixed rates are.
Yeah.
So they do cost you, but you can just go and fix that mortgage up. But in the meantime, they're getting paid off twice as fast.
Yeah. Well, I won't keep you too much longer, mate, because I can hear the clients are just chewing your phone off there. Are we going to move into? It's probably asking you to see the future a little bit, but are we going to move into a time where the banks start competing with each other quite heavily for the customer? Like, are we going to be the ones that win at the end of this, or are they actually going to sit there and go, shit, we're trying to pluck the best ones out of the market because we are trying to hedge ourselves and worry about our risk a bit?
It's an interesting one. Like each bank, and I noticed this massively behind the scenes because I remember when I wasn't in the game. A bank's a bank, right? You just think they're all the same. They're just a different label. They've all got sort of a different target market, and you can tell that by learning their policies and things like that. When it comes into competing and things like that, that's normally when the economy is running real hot. So right now they've gone back. They're probably back to their basics a little bit, sticking to their policy and really focusing on what they consider their ideal client. And it's just about having the right mortgage advisor to show you which bank that will be that suits you. But yeah, it's probably going to be like that for a while. When we come out the other side of this pandemic, who knows what could happen? Out of 2008, there was all sorts of differences,
Yeah. Are you comfortable touching on this question in the comments here, mate, or is this something you probably shouldn't be talking about online? Don't know.
Got and build an investment portfolio is a good strategy. Mate, last Monday I went and signed up a brand new build myself for an investment property. So
good strategy, Mikey says.
Went unconditional, no worries. Don't worry about it.
there's never one size fits all with this type of thing, right?
The type of thing is, it's a good question, but it would take like sitting down and then looking at financial sort of situation and scenario, and then going from there.
Yeah.
To be honest, the Reserve Bank has removed the LVR restrictions, so there's not too much in terms of advantage of getting around LVRs in terms of new build stuff at the moment. There's the occasional first home buyer that can sneak in with a 5% deposit, but I'd rather that you had a bit more anyway.
Top man. All right, well, we'll let you go because we'll go and watch this announcement at 3 o'clock. Was there anything I haven't asked you that I should ask you, or is there anything that you would explain to people to think about, or what's some little top tips from Mikey Smith?
I think it's just the 6 months out thing. I mean, we covered it briefly. If you are looking and you really want to buy a home, whether it's just taking out a loan from the bank for a rental property, for a residential property, you need to be thinking about at least 6 months in advance and have your accounts and everything set up to show that you're ready to go on that day when we do submit it.
Good man.
Just send an email and I'll send you the list of what you need to do.
Oh, there you go. All right. We've got your email in the comments here, so if anyone wants that list, then you can drop Mikey a line. Thank you for your time, mate. I think I know that a lot of Kiwis, especially younger people, are scared to ask these sorts of things. So I think it's important to do these types of streams and know that guys our age and even younger are working in this industry and they're trying to figure it out too, and that it's not all, doom and gloom and scary, and you don't have to know all of this stuff. It's constantly changing. That's why, you seek advice from smart people. It's what they're there for. So thanks for sharing some of the insights, mate.
Awesome, mate. Good on all the guys that have signed up to keep the change. It's really good to see.
Thanks, mate.
All right. See ya.